Hi everyone, thanks for joining us. I'll take the next 2 to 3 minutes to introduce our speaker Jyoti, then we'll jump right into a presentation. Jyoti is an infrastructure finance specialist at the World Bank, where she works on infrastructure finance, sustainable development goals, ESG investing, and public-private partnerships (PPP), which is our topic for the day. She has worked extensively with developing countries to support their public investment pipelines and preparation of PPP projects. Also, Jyoti has worked in the Macroeconomic Policy and Finance for Development units in the United Nations Asia headquarters in Bangkok between 2018 and 2020. At the United Nations, Jyoti was leading the dialogue on the SDG 2030 agenda, economics and financing issues for Asia, and she has authored the UN flagship report on sustainable recovery, many policy briefs, blogs, and papers on infrastructure finance, including serving as the Associate Director of the Journal of Infrastructure, Policy, and Development at the Lee Kuan Yew School of Public Policy at the National University of Singapore. For her distinguished service, Jyoti was conferred the World Bank President's Excellence Award, which is the highest award at the World Bank, and she has led the development of the PPP certification program to promote greater knowledge on PPP. We are so happy to have you with us today, Jyoti. Welcome to Princeton virtually. And the Zoom floor is yours.
All right, thank you everyone. Hello. It's really a pleasure to be here and talking to all of you. It's really wonderful to be part of your school's initiative to learn about what is really going on in developing countries, which I find is where really our future work is going to come from, and the new ideas. So it's really wonderful. And I actually want to continue to hear from you during my presentation. I will try my best to make it interactive so that you also share your ideas, because really there are no right or wrong answers. And I have some polls, and I have also some questions for you. So please, feel free to respond to what you think in the field of infrastructure finance and public-private partnerships. One disclaimer, I do have a lot of acronyms in the presentation, which I think we kind of become used to. It's kind of comes with the job. So I apologize in advance. But I think if you have a questions, please feel free to put it on the chat and also reach out to me later. So I'm looking forward. So let me just share my screen. And Chang, if you can just confirm, you can see my screen, yeah?
Yes, we could see your screen, but it's not in full screen at the moment. Now it's in full screen.
Okay.
Oh, good.
All right. Thank you so much. So thank you for the introduction, and thank you for the invitation. This is a presentation to the Princeton University. I just want to also remind you that these are my views. They do not represent the World Bank Group. Although a lot of information is obviously based from my projects and my work at both at the World Bank and United Nations. Now let's first kind of see what we mean by infrastructure, and what in particular we mean by public infrastructure. And every country will have their own set of what the public sector is involved in terms of providing the infrastructure services to its citizens. But generally the categories are transportation, water, energy, telecommunication, digital technology, political infrastructure, which is the regulatory bodies, is extremely important. And then we get into the social infrastructure. So the top 4 or 5 are what we call economic infrastructure, which contributes to the economic development. And then the bottom 3 are education, health, and wellness infrastructure, which we call more social infrastructure, assets and services. Now here goes the first poll, and Chang, unfortunately, since I have on the presentation mode, I cannot actually switch on the poll. So here is the first poll, which I would like you to answer, and I'm just wondering if I'm able to see yes, I'm able to see the progress. So the first question is, where do you think the government actually funds this infrastructure, which we just saw on the previous slide? Is it free, do you think? We pay for it. Companies, private companies pay for it. Government can always print money. And then is it financed by public bonds? They can just issue some capital market in the capital market and raise money. Central government, a lot of the infrastructure, we live in big cities, and central government can just transfer the money to the cities and to the municipalities. And workers, what about the workers? Are they working for free since it's public, right? It's government is supposed to provide to us all these services. That's what our expectation is. And money magically appears, or any other ideas which you can always put in the chat. And you can only select one option here. So let's see what you think and what you have experienced in. Many of you are from outside US, so let's see how your experience has been in terms of government providing infrastructure services to you. So far we have 65%. Let's wait till if we can get to 75% at least, so that we have at least 3/4 of the people. So far I see it's public bonds and investments winning the prize. And it's interesting. It's very interesting how people think that infrastructure is funded. Let's have 1 or 2 more people. Okay, we are at 20 of 26. Okay. I think we can close it. Okay, so let's just kind of digest this very quickly. So nobody thinks it should be free, which is wonderful. Definitely, it should not be free. Take water infrastructure, for example, water which we get from the taps and whatnot. If we think that it's free, it's not. Users pay for it. Yes, that is true. Private companies can also pay for it, and that's what we are going to be discussing in the rest of the presentation. Government can print money. Yes, that is possible, but yes, it has a cost. Public bonds and investment, that is a very important source of funding for the government, especially in the US at the municipality level. Municipal bonds are quite popular. Central government transfers money. That is also a very good source for local subnational, as we call subnational governments, the central government transfers. And workers do not work for free. They are employees, so they need to be paid. That means government is incurring an expense. Money, nobody chose money magically does not appear. And any other ideas? So that's great. So if you, Chang, am I able to see the chat? Yes, I'm able to see the chat. Okay, taxes. Actually that's the one of the biggest source of infrastructure funding. So it's and I want to make sure that you understand that it's not just one source of money. It's a combination. Donors is a very good example. Keep typing, really. So I will keep presenting, and I want you to really come up with these ideas, because there's unlimited options, really. So the next slide, I want to multilaterals again. So the next slide I want to present to you is how much money do we need? We obviously need a lot. We need a lot of money, and again, please keep in mind, we are talking about developing countries. That is where the World Bank and multilaterals work. So East Asia and Pacific has spent about 5.8% of its GDP, Central Asia 4%, Latin America has spent 2.8%, MENA region, Middle East and North Africa 6.9%, South Asia 4.8%. And on the right side, if you see the graph, how much in the future they need, you can see it's a wide variety of, the range is quite big, and the countries are not spending, they are not really spending enough what they should to achieve the targets which they have in terms of their economic development. And what are the challenges? In infrastructure, there are many challenges which are quite common among most of the countries which we see, actually including in OECD countries, which includes the US, which are developed countries. Cost overrun, a lack of holistic long-term plan, corruption, there's limited capacity among the public officials and also in the market. It's very input driven. How much construction we can do, that is an input. An output would be, or output would be how many cars are traveling on that road, and outcome would be a reduction of congestion, quality of life, reduction in number of accidents. Those will be the outcomes. Delay in delivery. I think all of us have seen construction taking longer and longer, and lack of maintenance. Now, in terms of, despite these challenges, right? I mean, the average number, according to the World Bank, what we need is a 4.5% of GDP. Now, those are only new investments, but is that the only answer? We need to have what we currently have in terms of infrastructure. We need to make it more efficient. So new infrastructure is not the only answer. We need to invest in more smarter ways, where the same piece of infrastructure or asset can be used to deliver better outcomes and quality outcomes, and a whole life cycle approach. And what does that mean? And I will show you that in momentarily. The infrastructure life cycle has, it's what you see when you are traveling on a road, or when you're going over a bridge, or you're using the airport, is only the last part of the infrastructure life cycle, actually. The beginning is where the planning takes place, and it takes a long time. What do we need? The needs analysis for a government, and that's why we have these census. Like, what are the future generations going to look like? Because the infrastructure is intergenerational. What we build today is not for the generation which is living today, it's actually for the future generation. So that planning takes a long time. And then you have the preparation. Once the planning takes place, then you have each project needs to be prepared in a way. What will it cost? What will the design be? How will it address the needs which have been identified in the planning stage? And then also we have a lot of other analysis, including cost-benefit analysis, to make sure it's economically viable, environment, social, and life cycle costing. And especially growing, increasingly, environment and social has become increasingly more and more important as we are incorporating climate change aspects. And then the next stage becomes procurement, where you actually go to the market and say, okay, how can I actually build this and provide the service? And there are two methods of that, which is public procurement and PPP. And then implementation is designing, construction, and operations and management. And each of these stages is a different decision. So the planning stage is an investment decision. Which infrastructure I need to build? Preparation will mean how do I actually prepare the project and procure that particular project which I have selected from the investment decision. And then the next decision is how do I finance it? So procurement and financing are two different decisions. And then the last one is asset management, because you have the asset, you have to manage it for the next 30, 50, 100 years. Now, the next question I want to ask everybody is, what do you think is a PPP, public-private partnership? How does private sector come into the picture of what public infrastructure is? Because it is public, right? I mean, can private sector really can participate in this? But it's not private infrastructure we are talking about. These are not private companies. These are not buildings. All these big business parks which you see. What is the role of the private sector in provision of public infrastructure services. So please feel free to type in the chat what you think. Again, no right or wrong answer. And that's why the acronym is called PPP. So far, public-private partnership, yes. So what would that mean in terms of a partnership? What kind of partnerships are we talking about? Public sector contributing to upfront cost, a private sector contributing to costing in return for running ongoing. Yes, that's true. Sharing of risk and financing, great answer. Risk rewards are distributed between private and public sector, great. These are all correct answers. Could be just development, yes. It could be just operations, could be just one of the functions. So what we mean by public-private partnership is an option to procure, is option to render services, what public sector is supposed to do. Because there could, as we saw, there are many challenges for the public sector. So there are a couple of different things which are applicable to a PPP. It has to be a long-term contract because infrastructure is a long-term provision. It has to be a long-term contract, ideally should be more than 10 or 15 years. There are contracts sometimes 20 years, 30 years, even 50 years, 100 years. And there has to be a transfer of risk from the government to the private sector. There has to be a transfer. And the payment from the public sector to the private contractor, the concessionaire, or from the users has to be linked based on performance. It is not based on inputs. It is based on performance. For example, on the road, it would be how well how fast and how well the potholes are being filled, and how quickly the road can be made available to the users of that particular toll road. Now, PPPs can be two types, where the users, as a user of that infrastructure service, can be paying to the private concessionaire, or the government can actually be paying using availability payment. PPPs are not same as privatization. This is a very distinct concept. Privatization is where you have a public company and you invite the private sector to take some equity share. And PPPs are distinctly available to the private sector to actually participate in what remains as the public sector. So this is an example of public procurement. So if we kind of, this is not very scientific, this is basically just a drawing, a very rough drawing of a public procurement, how a cash flow would look like from the government perspective. And this is the red line, which is kind of drawn. So as we saw previously, the planning stage, the government is incurring costs. The government doesn't realize, what we don't realize is government is incurring costs. And sometimes these planning stages could be even 10 years, 20 years. The same project could have been discussed again and again and again, especially if it's a very complex project and involves, let's say if in an urban area, they've been thinking about this road or this particular digging the tunnels for utility lines and stuff like that. It's very hard to really move the infrastructure which is already built. So it can take many, many years, and especially if the government has changed political cycles. So the decision making actually takes much longer. So there is a cost being incurred already. And then you reach the preparation procurement stage. Again, a lot of these due diligence assessments, which we call VFM, is value for money. FRM is fiscal risk management. Fiscal risk management has to do with affordability at the fiscal level, whether the government can actually afford to do this project, which is extremely important. And then only we reach the construction and to the operation and maintenance. And you can see that the government is going to be incurring all the risks. Again, it's about the risks. So whatever happens, the upside, downside of planning and preparing and procuring and implementing this project, the government has to take all the risks. Now, if it's a PPP, in case the government is actually paying to the private concessionaire, then there is going to be sharing of risks. So again, the planning stage is not going to differ much for the government because it is public infrastructure. Preparation and procurement is going to remain the same in the beginning, but it's going to go down slightly. And then the financing of the capital expenditure is going to go down because there is an assumption that the private sector will fund it. And then the government is going to pay. So this green part is going to change a little bit from the previous scenario, where the government is going to be paying an availability payment to the private concessionaire. So on net present value basis, it's going to be less. And also because the risks are shared with the private sector, the project quality and the performance is going to be more efficiently delivered by the end of the contract. Now, if it's a user pay PPP, where the users of the toll road or people who are buying the water or people who are buying the electricity are paying directly, and that means what we pay in our bills is going to cover the capital expenditures, it's going to cover the operational and maintenance expenditures, and the return to the private concessionaire, then the government expenses are much lower, as you can see in the red line. Now, how do PPPs work? They are traditionally, sorry, I'm trying to move the chat box away from this. The advantage of a PPP is it's bundle. It's basically bringing economies of scale. Traditionally, what you see in a public procurement is a construction contract. A city or the government hires a construction contractor, and they come and build the road, they come and build the building, and then they leave. So obviously they're going to be bidding on basis of what needs to be built. They're not going to be bidding based on what needs to be delivered, what services is going to be used, how can I maintain this particular asset for the next 30 years. So it's a very different mindset when you're bidding on and when you're planning on that particular infrastructure. So the bundling effect actually has this pressure that you only build which you can operate and maintain for the next 30 years, because you're going to be on the hook for 30 years, not just for the first 2 years when you're just constructing and leaving. The government will continue to be engaged. PPP does not mean that the government is going to step out. It has a very strong role, especially on the regulation side, if it's a user pay kind of contract. The SPVs are kind of formed, and I will go through some of the intricacies of SPV. So let me skip this bullet point. And finally, the asset remains public. So the government will take over the responsibility of the asset at the end of the line. So the government still needs to kind of think about that. Now, what can the private sector do? So these are the types of contract, which, and I'm glad to see some of these things in the chat, because private sector can deliver any of these functions. So D stands for designing the infrastructure. B stands for building or upgrading or renovating. F stands for financing the capital investment. O stands for operation. M stands for maintenance. So it's D, B, F, O, M. And you will hear this acronym many times, even in your search on Google. When you're reading these documents, you will hear DBFOM or combination of it. You can hear DOM. You can hear even BOT, or different acronyms are being used. But basically, keep in mind what these. Sorry, I was on mute for a second. And again, who will pay for the private party? As we went through, it's a user pay or a government pay. So 2 ways to pay the private concessionaire. These are the different types of contracts. You start from the very, very basic public owning and operating the asset on the red circles, utility restructuring, civil works, which is the most common work which you have seen, civil works and service contracts. And then we go into the middle boxes, which is more of the PPP relationships, management and operating contracts, where you are beginning to see that risk sharing between the two parties, lease contracts, concession, BOTs, again, build, operate, transfer, BOT, BBFOM, joint ventures, and then we have full divestiture, where the assets, public assets, are completely, they're transferred to the private company. Why are they needed? I think it's the most value addition is efficiency. It's value for money because of the risk transfer. Unfortunately, most of the governments think that it is because of the lower cost to the government. It is not, and that is a misconception, really, that the government's role is diminished and they don't need to be involved just because they don't have the money. They can just give it out to, they can give it to the private concessionaire. That is absolutely not true. The main objective of PPP is to bring efficiency in terms of cost management, life cycle management, reliability, innovation, risk management, and utilization. No government can bring all the value addition for a particular service as a private sector, because private sector is what they do best. They innovate, they bring value addition in terms of technology, in terms of labor, in terms of the ideas, in terms of value propositions. So that is where the PPPs can really help the governments. Now, there are two ways to finance, and this is very basic finance 101. I don't know how many of you are finance majors, but there are basically two different kinds of types of financing. One is corporate finance, and the second one is project finance. And whenever we are talking about PPPs, we are generally talking about the project finance, which is on the right side. Corporate finance is when the corporate itself, the main company itself, actually puts its money on the table to finance these projects, these PPPs, so that both the asset and liability is on their balance sheet. In the project finance, on the other hand, the corporate company puts a little bit money in a separate company, which we call SPV, which is special purpose vehicle. And so instead of being a liability, it becomes an asset. And that asset basically is the one which is delivering that particular infrastructure and earning a return. And that cash flow can go up the chain as equity return to the corporate company. So there are two different ways to be involved in PPPs. Generally, what you will see is project finance style, and it's quite a big field in infrastructure. Most investment banks you will see have their own project finance departments. Now, the difference between these two is going to be this is a very simplistic view, really, but you will see there's a lot of difference. I mean, there are fields. The two fields are very, very different. In terms of pricing, the project finance is higher because you're taking more risk. Actually, let me go back. So the other thing which you have to keep in mind is corporate finance. You already have a corporate setup, so it's been, let's say, in business for 100 years. So the market knows the company. The market has lent it money. The market has, they know who is in the management board, what does the company do, they have established balance sheets. But in project finance, when the SPV is formed, it's formed at that point when the bidding starts. So that means it does not have any history. It doesn't have any track record. So the market really doesn't know if the SPV is actually going to perform. So what happens, it's a higher risk. So the pricing for a project finance deal is generally higher. The tenor, the debt tenor is generally longer because, again, you have to match asset and liability. Infrastructure is a long-term asset, and you have to match your debt payment as and when the revenue starts coming. Complexity, project finance are hugely complex. There are tons and tons of legal agreements between every party, because to put in black and white what risks everybody else is going to take. Security, there's a huge security, because since you don't have any track record in the market, the SPVs are going to be requiring a lot of security to the commercial banks, that in case the project doesn't function, then you can actually call on my security. Which is very similar to, let's say, if you're buying a new house and you have never bought anything before, you will need to pretty much maybe ask your parents or somebody else to come in as a guarantor, that in case you're not able to pay the mortgage, somebody else, that particular person, can actually pay it. And so, and the recourse is limited to the corporate company in project finance deal. It's only limited to that equity investment to the corporate. So if the actual PPP goes it fails basically. So the lenders cannot just go to the corporate and say, okay, you pay me. They can only rely on the percentage of involvement in that SPV. Now, importance of risk analysis is huge because as I think you're hearing me mention the word risk a lot, because PPP is all about risk. Identifying, analyzing, mitigating, and building a case that, yes, I'm able to take these risks. I'm able to take these risks, manage it, and make money. So my downside risk is manageable. Now, the second poll I have for you is, what are the different types of risks which you should consider in when you are preparing your bid for a PPP? Go ahead and type some answers, what you think, in the chat. And think about the next 30, 50 years, not about today, right? You're signing a contract, a long-term contract. Long gestation, yes. Climate change, very good. Risk of low usage, yes. Demand risk, right? I mean, if you don't get revenue, how do we know if people are going to be buying that product or using that particular service? Changing politics, yes, very good. Again, in governments change, are they going to take the same contract at the same level? Is the transfer of power going to be peaceful? In many of the countries, it's not. Credit risk, yes. Political sovereign risk, very good. So these are all great answers. So in addition to what risks are out there, who is going to bear that risk? Political risk. Is a private sector, and my question is to Jack, right? Jack, what do you think? Is the private sector would be willing to take political risk? And Ajita, you also mentioned changing politics. So what do you think? Is the private sector going to be able to take political and changing political elections and all this kind of risks? No, exactly. So you see, the risks are there, and they can be there, right? I mean, we can make a long list of risks, but if nobody is willing to take them, then nobody's going to come to the table. Nobody's going to bid on that project. So these are just some of the risks which sample, let's say for the purposes of sampling the kind of risks and the buckets. So we have a whole long list. We have political risks, ENS is environment and social risks, sponsor equity risk, land risk, construction, technology, operation and maintenance risk, feedstock risk, revenue, counterparty, foreign exchange, FX is foreign exchange, interest rate, legal regulatory risk, right? Now, my question to you again on the chat box is, where do you think, now we are going through this very unprecedented event in our lives, right? Of course, we are thinking about how we are managing it. I want you to think about public infrastructure. How do you think governments are managing it? There are existing contracts with private sector. How is COVID-19 affecting these contracts? And that means our services, which the government is providing us. How each of these risks is basically affected by the pandemic. So if you, user pays, suffers under low usage, exactly, right? Demand is low. Let's say if we, the New Jersey Turnpike, we pay a toll, and it's if there's not enough people using that New Jersey Turnpike, there's not enough toll. That means there's low cash flow. If you have low cash flow, that means you're not able to cover your operation and maintenance expenses. You're not able to service the debt to the lenders. And if you don't pay the lenders, then you are in default, basically, right? Foreign exchange risk, exactly. Especially in countries where the currency is becoming even more unstable because of a lot of macroeconomic issues which are beginning to surface because of lack of or low economic activity in those countries, right? So what I have in this presentation is a long list of description of each of these risks. And without going into the detail of it, because I will send the presentation, which can be circulated and have a look at it. I want to just mention a couple of them. Construction risk is a huge risk. What we see in a normal public procurement, in a normal service contract, is government takes 100% of construction risk. And if the project gets delayed, the money is not there. How many times in our countries we have seen that a tunnel was being built and the government says, oh, it will be built by next summer. And it's still, even after 2 years, it's still continuing to build. A great example is the Eurotunnel. Originally, they had anticipated, I think, 1 or 2 years, and then I don't remember the exact, but it took longer and longer because there's a lot of conditions which we actually don't see, and we only find out when we actually dig the ground or when we actually start talking to people. We have to move the houses. We have to resettle them. It will take longer and longer. So the construction risk is a huge risk in infrastructure, and not many bidders are willing to take it completely uncovered. So there are a lot of different ways where you can mitigate this. So construction risk, if you remember some of the risk from this presentation, construction risk is one of the big ones. Revenue risk is another one, which also you can also do a /revenue/demand risk, which some of you have already mentioned. Demand risk, how am I going to be paid back? I'm putting $100,000 or $100 million to build this piece of infrastructure. How am I going to be paid? So construction and demand risk are huge in PPPs, and they need to be completely mitigated. No lender is going to lend any money without seeing a full covered contract, a contractual structure in a PPP. Counterparty is the one who's signing, so is the government basically, and this is where your political risk also kind of come in. Foreign exchange, interest rate risk, especially if you have international bidders coming into the country. Legal regulatory risk. So for example, regulatory is a very important function, and this risk can only be taken by governments because it is government's regulation. It is government's legal structure which is defining and facilitating that particular contract. And if the law changes, then the private sector would want to cover that risk, saying in the contract that, let's say the tax is 20%, and if during the contract the tax rate changes to 25%, that change has to be covered by either the contract has to be renegotiated, or the government has to keep to the contract which was originally signed. So there are a lot of, same thing for prices, for tariffs, for example, electricity prices, tariffs for, let's say for water, if you're delivering water infrastructure, what price you can charge to the users. These are all regulatory risks. Political risks, we mentioned, environment, social. So environment, social includes climate change. Climate change actually affects all the risks, but mostly on the environmental and social side, which include the direct beneficiaries and indirect beneficiaries. These kind of due diligence processes are becoming even bigger and bigger in terms of their coverage and their importance. Now, the next question I have for you is importance of independent consultants. Obviously, lenders are not experts in every field. And if you remember the first slide, what kind of public infrastructure we are talking about, it's a huge field. And this question is important for you all as you're thinking about your careers after you graduate from school, because many of you will be working in one of these fields. So what are the different consultants which are needed to make a team of PPP experts? It's not just finance. As you can see, there are a variety of risks which are involved, a variety of due diligence which needs to be done. It will take years. It may even take different consultants from both private side and from the public side, because public sector is not fully does not have the full capacity to actually understand what is going to happen. So what kind of consultants do you think? So so type in the chat room, or what do you think the competencies of the consultants should be? Again, no right or wrong answers. So far, you've been giving great answers, actually. Engineering, great. Engineering infrastructure means engineers, right? Statistical analysis, you need data. If you don't have data, you cannot make the analysis. Political risk analysts, yes. Demographers, urban planners, great. Community engagement, extremely important. Community engagement, stakeholder engagement. Equity consultants, yes. Environmental auditors, yes. So these are all great answers. It's truly, there is no limit. So there are legal advisors, there are technical advisors, there are environment and social advisors, resource consultants, there are market consultants, depending on the complexity of the projects. There are all kinds of consultancies out there, all kinds of firms out there who are experts, really experts in just one risk or one issue of how they need to build a good project so that it delivers services to achieve better outcomes down the road. Now, all these risks, they need to be managed through documentation. Of course, we can find the risks, but if it's not in the contracts, which are signed between the parties, then they are not really covered by anyone. And actually, the residual risk, since it's public infrastructure, it always lies with the government. So more due diligence, more preparation the government does in preparing these projects, better the outcomes will be. Project finance term sheet. Any project, it will have a term sheet. What are the terms and conditions when it goes to bidding? Generally, maybe it has about sponsors, the name of the company, what kind of contract it's going to be, what is being asked of the private sector. In this case, it's design, build, finance, operate, and maintain. The project is 400 megawatt. It's an electricity plant. The expectation of the commercial operations date is let's say in the next in the next year or in the next 2 years. The DE is debt versus equity ratio 70-80. That's the expectation. The debt service coverage ratio, DSCR, is 1.3, and tenor of the loan is 18 years and is about 500 million loan. And all these terms and conditions are laid out very clearly. And that's for the negotiation. One of the point of negotiation is these terms and conditions. So there are a lot of these. It's quite long, it's quite comprehensive. And then the cash flow. If many of you are in finance, I am a finance specialist, but I tend to focus more on the financing details. But as I said in my earlier slide, you have to be specialist in so many different fields. You have to be an economist, you have to be a lawyer, you have to be an engineer, you have to be a strategist, you have to be a team leader, you have to be even an educator. Community engagement is completely very important. So in terms of the finance, the cash flow would work like, what is the money I'm getting? How can I cover my operating costs, my maintenance? I need to pay taxes, I need to pay the interest. So this is the order of payment, which kind of, we call it the cash flow waterfall. The debt interest, and then I need to pay the principal. The reserve accounts, they could be for maintenance, they could be for all sorts of complexity in the projects, and only at the last will be the dividends to the equity stake, which is the return which we are talking about. The common misconceptions of PPP, it needs to really build skills on in the government. The government is the driver. The second one is the private sector is not a panacea. The government will always remain in the driver's seat. Just because the private sector is constructing and delivering the project, it doesn't mean it doesn't have a role. Government will always remain in the driving seat. And the PPPs have prescriptive and tight control. That's a misconception. It is an overall simpler framework. As long as the risks are identified and they are kind of allocated, let's assume you have a deck of cards and you're kind of giving each card to someone and it's covered, then it actually becomes very simple. Everybody should know what they're supposed to do. They usually have higher return, PPPs in reality, and they are, the unsolicited proposals is a technical term. Unsolicited proposals are proposals where a company can actually go to the public sector, to a public authority, and say, I want to build this project, and then the public authority says, okay, I don't know whether this project is needed. I don't know if you have a good deal, whether you're offering me a good way to build this project. Are you giving me a good price? I don't know. The only way to know is through competitive bidding. So whenever we are talking about a PPP, we are talking about competitive bidding. But in reality, there are a lot of unsolicited proposals. That means the government has not gone out to the market and has not solicited those bids. But there are a lot of unsolicited proposals in reality, especially in developing countries. PPP is not off balance sheet. You will hear this. Unfortunately, many of my peers are still talking about PPP as off balance sheet. It is not. It is, the governments have to assess fiscal risks, which are emerging from PPPs. It is about risk sharing. Now, I want to just mention a project just to kind of ground whatever what I've presented in the previous slide. And just a little, I thought it would be nice to know from all of you, if you actually know where Timor-Leste is. It's a small country, tiny, teeny country, and it's an important country for the World Bank. And let me see, okay, Southeast Asia, any other? Indonesia. See, when we have people, students coming from Asia, it's not fair, right? I wonder if students who are not coming from Asia, they know where Timor-Leste is. So yes, Timor-Leste is among the isles of the islands which make the archipelago of Indonesia, and so you should look it up. It's very interesting. Timor-Leste has had a very interesting history. So anyway, so this particular project is the port project in Timor-Leste. So this is how we basically present a project. It's a very tabular form. We say who's a grantor, what is the project cost, what does the project do, whether it's a greenfield. Greenfield means it's a new project. Brownfield means it's already there, and then you're kind of either you're upgrading it, renovating it, or you're adding to it. And as concession, these are the terms which we use in a PPP. Concession period is 30 years. It's until 2047. Extension could be 10 years. What is the contract type? Again, build, operate, and transfer. So private company will come and build it. They will operate it, and they will transfer. Do you notice something is missing among all the acronyms which we mentioned, DBFOM? F is missing here. So there's no finance. So it's building, operating, and transfer. And these are the services which the project details, the services which the project's going to. And so let's look at the financing. It's a project cost is 490 million. Public sector is providing 130 million. Private is 360 million. So it's a combination of financing. Okay. So finance doesn't need to be either or. And like all of you said in the chat earlier, financing can come from different, even from capital markets. It could come from the private company can issue a bond. The government can also issue a bond. And the main parties are these, which are listed here. World Bank was involved, ADB, PF, and IFC. And the government revenue is basically through royalty fees, which the private company is paying to the government, royalty fee and navigation and dockage and tax income. So because we need to look at the benefit both to the private company and to the government when we do these analysis. And this is a contractual structure, this is the spider chart, which we call in the PPP or project finance. Basically in the middle is the SPV. And then we kind of draw arrows on who is doing what. So it is also the function, but it also tells you the kind of risk which every party is taking. And construction, operations, and maintenance, lenders are providing this, users, and then you have concession agreement between the government and the SPV. And these are the risks. Who takes the political, traffic, currency? Currency is an interesting item here I want to highlight because it was in Timor-Leste. The contract was signed in, I think a couple of you mentioned foreign exchange risk. It was signed, the contract is signed in US dollars. So obviously it's a huge risk for the concessionaire. The government normally doesn't want to sign a contract in US dollars because it doesn't have the ability to manage the US dollar. But at that time, Timor-Leste was using US dollar. And I think there is still discussion on changing the currency. But so the risk mitigation had to be built in the contract, which mentions the exchange rate fluctuations. And eventually, if the exchange rate actually changes quite drastically, then there's an automatic adjustment in the tariff, which the port concessionaire can charge to the users. So there's an environmental social impact and what kind of actions were taken and what is the benefit. See, again, so we are doing this project not to build the asset. We are doing this project because of the outcomes. So the benefit have to be assessed right in the beginning, and they should be assessed periodically during the project. Now, that's my presentation. And so I was asked to also give a little bit of maybe a walkthrough of the PPP certification website. Maybe let me ask the organizers, would you like me to just walk through the website or I can just end my presentation here?
Sure. Maybe we can have a quick overview of the program, whether or not we go to the website. I think we have about 20 more minutes for Q&A.
Okay.
Yeah.
Okay, so somehow I'm not able to click on this. So I think I will stop sharing this and then I'll go to the website directly. Are you able to see my screen right now or no?
We're not seeing the screen at the moment.
Okay, so let me now share. Okay. All right, so this is the PPP certificate. Yeah, okay, thank you. This is a PPP certification website. So if you just type ppp-certification.com, this is what you will see on the home page. And you can see at the bottom, it's a program which is jointly launched by all the multilateral development banks, World Bank Group, Islamic Development Bank, Inter-American Development Bank, European Bank for Reconstruction and Development, EBRD, and Asian Development Bank. And so basically we developed it and then all the other MDBs are sponsoring it together. So it's very nice that all of us came together and agreed. which is a feat in itself if you think about it. So it is a wonderful program. I think you should check it out. Students get a discount in terms of, it's a certification, just like CFA. Basically, you study the material. And the exams are based on the material. And if you go to the certification tab, you can see the PPP guide, which is a hugely comprehensive. We spend, I think, about 2 years developing this. So even if you're not interested in the exam, you can actually read all this material. It's quite comprehensive. So it kind of takes you from stages of how to develop the framework, the PPP framework, which is the legal and the regulation and the policies, how to identify a project, and then you have to screen the project to make sure it's the right project which you're doing, appraising the project, and then structuring and tendering, which is a procurement stage, and then going to the market. And then once you have the selected bidder, you award the contract, and the contractor basically delivers and commissions the infrastructure asset. And then you have to prepare for operations and hand back to the government. Now, in addition to the extensive material of the PPP guide, there's also a very long list of glossary, which I personally use all the time, because these are the definitions which we have agreed from the World Bank and other MDBs. And we went through a lot of market consultations. So it's quite long. As you can see, it goes from all the way from A to Z, and it just goes on and on and on. So you are able to refer to this and also cite it. It's perfectly fine. And then there are 3 exams. One is at the foundation level, which is based on chapter 1. And the online training is available actually on online course, and which you can take it. And then the preparation is basically preparing the project, which is based on chapter 2, 3, 4, and partly 5. And then there's a execution. How do you execute the project, which is part of chapter 5, 6, and 7, and 8. So after you study and you take the exam, and then you get the designation CP3P, which you have probably, I don't know if you've encountered some people who also have started adding in their names, just like CFA. So it's quite, I would recommend, if you do want to familiarize yourself with PPP and while you're studying, and if you want to take another certification, this is something which you could consider. And I think with that, I will end my presentation. Over to you.
Thanks a lot for the presentation, Jyoti. It was really engaging and insightful. So now we'll start with a Q&A. And please feel free to drop your questions in the chat, or raise your Zoom hand, and we will call on you to pose the question, time permitting. So we see that Pamela has a question on how do we ensure the integrity of PPP processes. You know, we see situations like chronizing cost inflation. Pamela, would you like to unmute, or the question itself is sufficient? Okay, so Jyoti, would you be able to share with us some thoughts on how do we ensure the PPP processes are able to address risks like corruption and cost inflation?
Yeah, no, I think it's a very good question. So this is what we call the governance structure, the governance issues which we face in every project, not just PPP. And of course, once you have private sector involved in a project, it actually even becomes more serious, because you have a third party which may or may not be able to influence the political process. So corruption is a huge issue. We are talking about countries which are fragile, which have conflict, which don't have not necessarily a well-functioning and integrated political system where one ministry is not talking to another one. So this is quite a big issue, and governance actually is a whole vice presidency in the World Bank. So one of the things which the PPP does, it actually mitigates this governance risk, because everything should be on paper. The tariff formula, the calculation, who will do it, how it will happen, it should be in the contract. How are the users, how is the private contractor going to be dealing with the collection of those payments? Where is the money going to come? Where is the money going to go? How is it going to be paid? All these accounts are escrow accounts. Basically, they're sitting somewhere else. So nobody can do a grab of those accounts, especially if it's sitting in a domestic bank. And if there are serious governance issues in that particular country, the lender is going to require an escrow account for all these payments. So the fact the PPP works because there's a lot of scrutiny. Everybody is looking at that contract, that contractual framework, basically. So government cannot just go ahead and take a random decision, because it is not really up to them. Because if they do take a random decision, then in the contract it will say that if the government does this, then it is their risk, and the government has to be, then basically they're taken for arbitration, and then eventually it's part of the dispute resolution process, and eventually to courts, and then there has to be an arbitral award. And that's another reason for multilateral banks. And I think somebody, maybe Chang, you mentioned the guarantee, right? That's why you also see the term political risk insurance. You also see the word guarantee. So multilateral banks and a lot of the private companies, you've heard about Swiss Re, Munich Re. That's why lenders and both the sponsors and the SPVs are going to be required to take insurance because of these issues in the emerging markets.
Ajita, you have a question?
Yes. Thank you, Jyoti. It was a very good presentation, and I'd like to introduce myself. I'm Ajita Agarwal. I'm a civil servant, and I've worked in the Indian Railways for 5 years. So I've implemented a couple of PPPs. And from my experience, I feel that it's a very distrustful kind of a relationship that the public and the private sector have when they're implementing projects. And even though the motives are kind of the same, they want to build the project, get done with it as soon as possible, but I've seen there's been a lot of harassment from both the sides. While the government tries to implement some regulations, some standards, or while the private sector is trying to just cut corners on various matters. Right. So in your experience, what have been some of the best practices from various governments in the developing world to build that trust between the public and the private sectors, so that, the regulations are evenly, applied through all the private sectors, and there's less of cronyism and there's less of harassment on both the sides?
Yeah, no, thanks, Ajita, and it's great that you've actually worked in some of these, and so you know how difficult it is to make a relationship between public and private sector. There is a distrust from both sides. Governments generally think, and still do today, that private sector is there just to make money, and private sector always distrusts the government because they're not disclosing everything, and there's always some angle which the government is trying to get, and basically make money, suck them dry almost. And so it's a very it's a dysfunctional relationship, and that's why the contractual structure is so important, and it just becomes longer and longer. Now the thing about lessons learned, well, first of all, the governments, I think the process has to start at the planning stage. More often than not, what governments do is they have a list of projects, and they go through what are the sources of financing those projects, and then they're left with some. And then they think, okay, these projects I can just put in the PPP bucket. So the problem starts from day one. Because if you are putting the wrong projects in the PPP bucket and thinking that private sector is going to come and resolve magically all their problems in terms of their financing, in terms of making the outcomes more valuable to the citizens, it's not going to work. Because those projects are basically not assessed to be both there are two things need to happen. They need to be economically viable and they need to be financially viable. And the governments are falling short of doing that second analysis, making sure that they can actually, these projects are financially viable so that they can actually become bankable. Bankable means that a bank can come and finance these projects. So if you put the wrong project in the market and you are bidding based on lowest cost, and if you get a bidder and you select that bidder, you will get what you pay for in a way. And these contracts are not going to last. They will fall through. So the first lesson learned really is that government need to do their homework, making sure that they actually screen the right projects, which can be best done through public procurement, or they can be put in the bucket for PPPs, and PPPs triggers a lot of additional assessments. So you have to do VFM, you have to do your FRM, fiscal risk assessment. They have to do a lot of additional environment and social assessments to make sure that all those risks are understood and they have a cost assigned to it and they can be captured in the contract. So that's one lesson learned. And the second lesson learned is knowing the market. If the governments don't know the market and they take the only bidder which comes, normally what you will see is these negotiations take years, sometimes years, and the competition, nobody trusts the competition. The government doesn't trust it, and the private sector doesn't trust it, whether it actually was a truly competitive bid. Generally it's done on the cost basis, not on the quality basis. So if the quality is not included, these contracts are not going to last. The third lesson learned is you have to be prepared for changes. You can sign the contract today for 30 years, but both parties have to agree that they're committed to the contract, to the relationship. That does not mean things are not going to change. Both parties have to be willing to adjust to the changes. They are going to happen. Nobody wants to walk away because both the parties have put money in it. So nobody wants to walk away. And they have to understand that, yes, there are going to be renegotiations, there are things that are going to change, there are going to be disagreements, but as long as both of them are willing to work on it. Because there's no contract which is going to stay the same as originally signed for the length and the duration of the contract.
Thank you.
Thanks. We have 5 more minutes before the session ends, but it's great to see that we have a lot of interest. Jack, followed by Juan Pablo and Jajun, would you be able to just briefly share your questions, and then we let Jyoti answer to all of your questions at the same time.
Okay. Good afternoon, Jyoti. Thank you for the presentation. I understand that you emphasized the importance of accountability and spelling things out in contracts. In your experience, have there been particular risks that are very risky that are very, potentially impactful to the success of PPPs, but that may not be easily captured in the contracts, either because they're very contingent or just because there are legal frameworks that are limited that cannot fully mitigate the risks? Thank you.
Thank you for the presentation. It was very enlightening. My question is more in the sense of international projects and contracts, and I'm curious if there is an experience or some thoughts about how can we ensure the transfer of technology or know-how from private enterprises from rich countries building projects into developing low-income countries.
Thank you, Jyoti, for the presentation. Just really quickly, I'm wondering, so I know that environmental, social, and governance is a part of the project pipeline, and you have.
Sorry, Jajun, I think the echo from your end is a little bit strong.
Is it better now?
Still the same. Perhaps you can type your question in the chat. We come to you shortly. And meanwhile, Jyoti, please feel free to address the questions that have been posed.
Okay, yeah, I was hearing a lot of echo. Thanks for, yeah, just type your question and then I will have a look. Okay, so on the first question, Jack, on the which risk is, it really depends on the project. Every project is different. So, you know, thing about PPPs is there's no one size fit all solution, really. So each project, it could be, and it doesn't necessarily mean on the size of the cost of the project. The complexity can actually even come in a very small project. So generally, I mean, if very, very generally in terms of the risk, it's really the construction and the demand risk. Construction, because you do not know what you will find once you start digging. And demand, because you do not know where the money is gonna, how stable is that stream in terms of your traffic forecast, for example, is going to actually happen. Is it going to happen from day one? Is it going to happen in 10 years? So how do you match the revenue stream to what you want to build today? You know, I don't know how many of you are familiar with Dulles Airport in the Washington, D.C. area, right? It was built in, I think, if I remember, 3 phases, right? A lot of times governments do phases because they don't know how well the traffic is gonna actually materialize over the future years, so that you can actually fund that that funding which will come from the revenue to finance the capital expenditure. Funding, financing, 2 different things. So so in terms of the risks, key risks are construction and revenue risks. Now, in the next question on technology transfer from developed countries to developing countries, I think it's a very big issue, especially given the climate change, which we are discussing today in terms of, let's say, the cost of new technology for the products which are considered more sustainable, they're emitting less. Let's say vehicles, right? Electric vehicles are, as you know, are much more common in developed countries rather than in developing countries, and the technology is just beginning to be basically researched and developed. R&D is just being developed in many of the developing countries, and of course, even in developing countries, there's a lot of variety. Then China is still a borrower from the World Bank, but you have developing countries like Brazil, Turkey, India, South Africa. And then you have smaller countries, which are, you know, you have Mali, Malawi, you have Paraguay, you have Peru, and then you have Indonesia. So it's a whole variety of countries. Some countries are beginning to have their own manufacturing on electric vehicles and develop their technologies. For example, in India, Mahindra and Mahindra is developing low emission. They already have a target on their own net zero, right? So they're developing technology. But in Africa, for example, and this is actually just a discussion we are having even this week and next week on decarbonization of transport, what is actually happening today is a lot of the vehicles which we use in our countries, in developed countries, in Europe and in Japan, and they're, after they burn out of their useful life, they're actually imported to Africa. So we're basically sending all these high carbon emitting vehicles to Africa and expecting those countries to still deal with their NDC, nationally determined contributions on Paris Agreement, which is completely convoluted, and there is no regulations. There is no check at the port of exit in Europe, for example, and there is no check at port of entry. So it's a huge issue, and the technology. So the question for us becomes, you know, as we are sitting in US or in any other developed country, how do we manage this? And do we make regulation at the national level? Do we make regulation at the international or the regional level? And that is a discussion it's a complex question and with a complex answer, which is a constant discussion among the development specialists. All right, so next question from Gia. I'll just read it. Environment's ESG safeguards and impact assessments are part of the project pipeline, but there are three ways. There are ways to ensure that the design of infrastructure is also green. For example, in Timor-Leste, making sure that coastal marine ecosystems are protected, leveraged in infra development. Yes, that is absolutely true. I agree with you. So the greening of infrastructure is mainly there are two ways, right? First is you select green projects, which is again at the planning and the screening stage. The second way is what you're planning to build, you build it sustainably. So in terms of new infrastructure. And then there's a third way, because you already have a lot of infrastructure and you kind of need to make it sustainable. So all these three ways need to work together in a way. And I was in a discussion last week with the UK Infrastructure and Projects Authority. They've collected some data, and they show that in a lifetime, in a person's lifetime, like in my lifetime, I will only see 5% of infrastructure being built. So 95% of the infrastructure which I will be using is actually already there. So in terms of my interaction with making new infrastructure sustainable, there's only so much leverage I have. So in more ways than less, actually the existing infrastructure, the choices which we make have to become even more sustainable.